You have to actually create a hypothetical pseudo model in your mind before you actually run the calculation. So hi guys and welcome to another video by Mentally Careers. My name is Alan and I'm a CFA charter holder. And today we're going to be talking about some advanced concepts in financial modeling, and specifically related to becoming better at thinking about financial modeling overall. Designing models, creating financial models for different cases. So I'm going to be focusing a lot on some very sensible things, very commonsensical things, which possibly you can incorporate in the entire practicing of financial modeling, which will just make you better. Of course, there is an element of experience which nobody can actually replace, but there are some approaches which you can change from now itself, which can give you a lot of advantage without even waiting for about 6 to 7 years of experience doing financial modeling. Right? So let's get cracking and let's discuss first what are the aspects or what are the areas that we're going to be discussing. So the first thing that we will be discussing is talking about the approach, right? So what is the approach? Second, we will talk about gathering data. Third, we will talk about the aspects related to taking the correct template. The fourth, we will be talking about foreseeing complications before they occur, right? So what are the ways by which you can actually see what are the complications that can happen when you start making a financial model, right? And finally, I will talk about a very commonsensical approach to check and validate your results, which popularly in the financial modeling community is called as a sense check, specifically in equity research, right? So let's get started with the first topic and let's discuss approach. Now, what do I mean by approach? Approach means that whenever we are making a financial model, right, before just blindly starting and creating financial models, you need to think about the way by which you're going to create this financial model. So you have to actually create a hypothetical pseudo model in your mind before you actually run the calculation. So there's a lot of rough work which has to happen before you get to getting very detailed into the process itself, right? So first, answer yourself in every financial model, whether it's a business model, whether it's a startup model, whether it's an equity research model, whether it's a project finance model, that what exactly is your objective? An objective can be different, right? So I've given some examples here. So for example, if you are planning to acquire a real estate commercial project, right, a property which you want to improve and then sell it away, so that is an objective. So your objective now is to find out what is the acquisition rate, right? So your cap rate, your acquisition rate is the thing of calculation that you want to perform, right? Now you'll understand why exactly I'm saying this, because every step after which comes out in the process of financial modeling is related to this process. So if this process is not set well, then later on in the more advanced steps, you will find that you made a mistake and then you'll have to again come back to this, right? So comparing business opportunities, are you instead of just acquiring a single real estate property, are you actually comparing two real estate projects, right? So if you're comparing, then you're talking about the returns. So you will also come to know what are the data points which I need to compare, right? Third, what is the fundamental value for stock? Let's say if you want to find out the fundamental value for stock, so then you are planning to calculate the intrinsic value. So you're not trying to calculate the returns or the IRR or NPV, but you're trying to calculate the intrinsic value. So what are the data points that will be needed, right? So a quick tip on this overall process is the mistake that most often amateurs who have just started creating or got into the process of creating models is not explicitly spending enough time trying to spend time on what exactly is the objective of a model, right? It may sound a little tedious, but if you spend this time out here, it will really simplify things at the later stages of making this financial model. Right? Let's go to the second step or the second area where you need to, if you improve or improvise using these tips, you can get better, right? So data gathering. Again, remember, if your first objective is not set well, that means if you don't clearly know what exactly you want to do, then your data gathering will also not be in sync, right? So the first question is to match the data collection or the sources with the model objective. So if it's an IRR calculation, then you need a lot of business setup data or maybe revenue data, right? So I'll give you some examples which will make you prove that why data gathering has to be thought through. For example, if even if you're making an equity valuation report in which you're going to be finding the intrinsic value, you have to understand that which are the data points which I will be needing and do I have it, right? You can't really say that, okay, I'll just put annual report data, because if you see out here, in creating and forecasting the company's performance in the future and finding the intrinsic value, the annual report will just give you the data of income statement, balance sheet, and cash flow, and that to historical. But in order to understand the business, the annual report is not really helping much, right? So you need quarterly reports. So why do I need quarterly reports? So that I understand what are the matrices which the company talks about, in terms of its operation, right? I will have to look at investor presentation, because if the data is not very clear in the quarterly reports, or those matrices are not given, maybe in the investor presentation we talk about certain revenue drivers or cost drivers which are important for this model, right? I might need con call transcripts to understand what the analysts are talking about. What are the important stuffs that they are focusing on, which I can probably research on for this model, right? And finally, brokerage reports to understand what other brokers or other equity research analysts tend to look at this business about. So this gives me an idea. So this is where data collection becomes very important. I'm not saying necessarily this is how it has to happen all the time, but you need to think about this process in much more detailed manner before starting to create the model itself, right? So a simple tip out here again. So sometimes when we approach blindly, since you will have so much data, then once you get the data and then you're trying to scramble through, where do I use this data, is going to be very futile exercise, right? So the best approach is to first decide on the objective and then look at the data, which will make it much more easier, right? So let's go to the next step, which is on the correct template. Now I have stressed all the time that having the correct template is very important, because you don't want to create a template which is unnecessary, right? For example, if you don't even have that kind of data and I'm creating 10 multiple sheets for calculation, it is just going to make my life difficult, because I will have to stream through one sheet to another sheet to another sheet. If it's required, then we can of course use it, right? So let me give you some examples out here, and I'll actually show you a real model just to make these things more just to give you a perspective, right? So if you see out here, this is a solar project model, right? And you can see that there is just one sheet of assumptions, and then I've got my project cost and interest during construction calculations, and then I've got my debt schedule, P&L, balance sheet and cash flow, and return price. So a very fairly simple model because of the nature of the business, right? So basis the nature of the business and the complexity of the business, I have made the model template in this way, right? But if it's, let's say, a project, if it's a case of creating, let's say, a port, right? Now in that case, probably I need to separate the P&L, balance sheet and cash flow, because the data itself is too high. Then I need to calculate the operating expenses separately. Then I need to calculate the depreciation separately, and then I need to calculate the capital allocation also separately. So because the project itself is so complicated, and each section has higher calculation, hence it makes sense to probably put it in a different sheet, right? So this is a complex shipping model, and I'll just quickly show you the real model itself so that you get a better perspective of what exactly I'm trying to say, right? So if you see out here, I've taken an example here. This is a very simple model out here. This is to calculate the acquisition rate, the correct acquisition rate, which will give us a 20% IRR for a real estate business. Right now, if you can see out here, the assumptions are pretty straightforward. We've got operating expenses, and since we're dealing with only one property, the calculation is even easier, right? So I've created the entire model in one sheet itself, because ultimately in a real estate model, all that matters is the cash flow calculation. So there was no need to create a separate income statement, a separate cash flow statement, and a separate balance sheet. In fact, I've not even created a balance sheet because it's not required, because we're talking about just calculating the returns that we would make if we bought this project at a certain rate and we exit at a certain rate, right? So as opposed to this, if you look at the shipping case out here, the business itself is a pretty complicated business, because the construction itself is taking so much time. So then I have to calculate the capex separately. I have to calculate the allocation of the capex separately. I have to calculate the depreciation separately. So you can clearly understand that basis the complexity of the assumptions of the model and how complex are you planning to make is how you decide on what kind of template you require. But of course, otherwise, never forget the basic hygiene factors is to always leave at least one row on the top to showcase what exactly you're working on in terms of the template, and leave at least one column in between before you start putting the data towards horizontal side so that you can put in such assumptions in the calculation. But be aware that whenever even if you're putting such assumptions, make sure that you're always linking to the assumption sheet and you do not always try to put a hard coding, right? For what I mean by this is, if you see out here, it is linked to the main sheet out here, the assumption itself, even if I put it here. But sometimes the mistakes can be that you could just put it directly, and this is what I'm saying to avoid. This is called as hard coding. Later on, while debugging the model, it will become very difficult, right? So let's get back to the topic after the template. So once you understand what kind of template you need, the other things that you need to always forget, remember is foreseeing complications. What do I mean by that? Of course, you cannot really, foresee everything that might be an issue at the end of the model. But yes, you can look at some of the major issues, which is keeping the model simple, right? Don't try to make the model over complex just because you can, right? Because you have to always understand that what is the objective of the model and who is going to be the user. So the model should be understood by a layman. At least we should try our best so that even a normal financially educated person can understand what exactly is going on, right? So some of the tips is avoid too many conditional formulas. If it's not required, please don't use it, because if you use too many conditional formulas to correct the conditional formulas will become difficult. So a one-liner conditional formula, logical operator to see whether the tax, specifically if you're talking about taxation calculation, it's fine, right? Avoid hard coding, just like I showed you. Avoid too many assumptions. When I mean too many assumptions, mean that when we start assuming too many things of the future, then our model becomes as good as the assumptions, right? Avoid curve fitting. What do I mean by curve fitting? Meaning that, for example, when I made a model and I got a returns of 6%, then just to make sure that the 6% becomes 19%, which makes me happy, then I try to tweak the assumptions. Finally, talking about sense check, right? So this is one of the most common sensible approaches to make sure that you do not embarrass yourself with creating a model which finally does not make sense. So always try to specifically any stronger calculations, right? Profit margins, EBITDA margins, maybe the IRR calculation, maybe the cash at hand, maybe the tax rate that you're assuming, or even maybe the intrinsic value that you have found out, right? Of overvaluation or undervaluation. Make sure to just take a seat back and try to ask whether these results actually make sense or not, right? So it's much better to critique your results again and again so that it will pass the real world test, and also when we are presenting the model, it's even better, right? I hope you like the video. I hope this will help you in creating better financial models. And I'll see you again next week with some interesting